So let's talk about Bitfarms. The crypto mining stock just had an absolutely monster day. But whenever a stock shoots up like this, there's always one big question. Is this a rocket ship on its way to the moon? Or is it just a firework that's about to fizzle out? Today, we're going to run a full technical health check to see what the charts are really telling us about this wild ride.
And this is the number that got everybody talking. A massive single-day jump of over 10.5%. A move like that, well, it definitely gets your attention, and it gets everyone asking the same thing.
Is this a real, genuine breakout that has the legs to keep running? Or is this just a temporary sugar rush that's going to fade away? To get to the bottom of it, we've got to look past the headlines and dive right into the technical data.
But before we get to the forecast, we need to zoom in on the price action itself. So let's just set the scene for what was, no doubt, a huge day for Bitfarms stock.
Okay, so here are the raw numbers. The stock closed the day at $4.61 after that big pop. But look at the volume. Over 103 million shares changed hands. That is some serious interest. And what's really important is that it's trading up near the top of its 52-week range. That tells you this isn't just some random move out of the blue. There's been some real underlying strength here for a while.
So a big one-day jump is exciting, for sure. But is it built on a solid foundation, or is the ground underneath a little shaky? That's our first check, the underlying trend.
And to answer that, we're going to start with one of the most fundamental tools in the toolbox, moving averages. There's a reason this is always the first stop. Think of them as a way to filter out all that chaotic day-to-day market noise. They smooth everything out to reveal the bigger, clearer picture of which way the stock is really heading.
And the verdict from the moving averages? It's pretty clear. Bitfarms' price is sitting comfortably above almost all of its key averages, whether you're looking at the short, medium, or long term. Now that is a big green flag for a bullish trend. But, and you knew there was a but coming, right? That 10-day average, sitting up at $5.02, is kind of looming overhead. It could act as a ceiling, a potential roadblock for this rally.
So the trend gets a thumbs up, but a trend is only as good as the power behind it. So the next big question is, does this rally have enough strength, enough momentum to actually push through that ceiling?
And this is where the story gets really interesting. Because while the main trend is giving us a green light, some of the other, more sensitive indicators are starting to flash some yellow warning signs.
One of the most critical warnings comes from an indicator called the MACD. It's a really powerful tool because it doesn't just look at the price, it measures the speed of the trend, basically to see if it's gaining steam or losing it. Now this is the key takeaway from the analysis. The MACD is showing what's known as a bearish divergence. In plain English, that means that even as the stock's price was hitting a new high, the actual momentum behind that move was getting weaker. It's like you're flooring the accelerator in your car, but the engine is actually starting to sputter. Not a great sign.
And this is the core conflict of our whole story right here. It's a total technical tug of war. On one hand, you've got other gauges, like the RSI, and they look pretty healthy, signaling positive momentum. But on the other hand, you've got that sputtering engine from the MACD, plus another short-term indicator that suggests this upward push is just about running out of gas.
Okay, so we've got a strong trend fighting against some weak momentum. So what's the tiebreaker? Well, it often comes down to the fuel that's powering the whole move. We're talking about volatility and, maybe most importantly, volume.
So, time for a fuel check. First, volatility is high. You can think of that as high-octane fuel. It powers these big moves, but it also makes everything a lot riskier. The volume picture is mixed. The buying pressure looks decent, which is good to see, but here's the real catch. The relative volume is actually low. What that means is, for such a huge price jump, there wasn't a huge crowd that showed up to the party. And that's definitely a bit of a red flag.
Okay, so we've checked the trend, we've analyzed the momentum, and we've gauged the fuel in the tank. Now it's time to put it all together. What's the final verdict from this whole technical deep dive?
It all really boils down to two very different paths from here. The bull case is pretty simple. The price has got to hold above that key support level at $4.45. If it does that, the door is open to test higher levels. But the bear case is just as clear. If that $4.45 support breaks, the floor could really give way, potentially leading to a pretty significant drop down to the next major support level at $2.09. So here they are, the exact numbers you're going to want to watch. 445 is the battle line. For the bulls, they need to break through 475 first. But a close above 502, that would be the major confirmation of strength.
These are the critical price points that are going to tell us which side is winning this fight.
So how do you trade this? Well, the strategy kind of breaks down into 3 simple steps. First, you can try to ride the short-term positive momentum, but you have to do it with caution. Second, you watch for a clean, decisive break above that first resistance at 475. And third, you wait for the final confirmation, a solid move above 502. That's the signal that the long-term trend is really back in the driver's seat. It's a patient, evidence-based game plan.
And that leaves us right here with this central conflict. You have a strong, bullish trend going head-to-head with some very cautious, even weak momentum signals. It is a classic technical standoff. The question now is, which one's going to win? The levels we've just laid out are going to tell the whole story. Thanks for digging into the charts with us today.